Something interesting happening with the VIX today. The put call ratio is showing that people are expecting a soft number going into tomorrow's CPI data report. We got the PPI data report this morning, and the markets basically took it in stride, didn't really push anything with the S&P 500 or any other stock market index too much high or low. It's pretty flat for the day. But the put call ratio on the S&P 500 tells us that people are buying in on puts just as an insurance policy. This has spiked the VIX upward. Let me explain how this works, because if you can understand this, you can see how people have positioned themselves going into this number and how they would so in other numbers. I've got two charts I want to show you. This one will be pretty simple to lay out for you. Let's jump in. Thanks for stopping by. This is my new channel. I've broken out of my original channel. I now have 3 channels. Links are down below. A lot of transitions going to happen with the content that I create, including big changes with the website. Make sure you hit the like and follow button on this particular channel and as well on the other 2 channels if that's the kind of content you're looking for. Thanks so much for following along. This is the VIX for today. Now, we did have a move lower with the stock market, but it wasn't that much. Negligible, about a quarter percent. During that period of time, the VIX itself shot up quite a bit comparatively when you look at the entire S&P 500, the movement there. But this is the chart I really want to show you. This is the put call ratio. So what happened was the VIX itself spiked up with the Dow or the S&P 500 moving lower, which it would on some level. But when we look at this put call ratio, we see some things that are happening. The put call ratio basically on the S&P 500, and this particular put call ratio is on both equities and indices. So it's kind of the big picture look, if you will. Typically, and we were trading at about 0.9 puts to calls. For every one call, only 0.9 puts are purchased. In this particular case, there was a big spike up. A bunch of people, a bunch of investors stepped in and bought a lot more puts today. They're likely, and this is a 30-day rolling. So what they're doing is they're buying puts for 30 days out. Most likely, individuals expect a number that the stock market itself may not simply take in stride, unlike what they did with the PPI today. Tomorrow, of course, we get inflation data. That inflation data could show that the Federal Reserve, yes, does need to raise interest rates one more time this year and will likely keep their foot on the brakes for some time with regard to whether or not they lower interest rates. I'm in the camp that I'm listening to the Federal Reserve. Interest rates will remain higher for longer. I do not expect the interest rate levels to move downward next year, 2024. In fact, I expect the Federal Reserve may have to step in and raise interest rates even more. So the put call ratio, if we look at this chart, what's happened is investors stepped in and bought more puts relative to the number of calls they're purchasing. When you think of the valuation of the VIX itself has a ratio calculator with the number as to how it's calculated. All right, so the VIX looks at the volatility index, and what they're doing is they're looking at 30-day options. All right, and if there is a ratio there, and let's call it 0.8 to 1 puts to calls, and each one is 1. What's happened is the puts, they've purchased more puts, and they've done so at a higher level. So they're driving up the price of puts and they're buying more relative to normal. And they're doing this on a 30-day outlook. So the expectation from the broader market is they're expecting a number that is going to get kind of ugly. And if that's the case, if we get a number that says that the inflation is not running lower as much as the Federal Reserve would like, which is something I'm expecting, you can expect the S&P 500 to sell off going into tomorrow's number. So much so that a lot of people either front run this number in a way of either buying insurance policies because maybe they have S&P 500s, and if this market does move lower, they want to protect themselves, or secondly, speculative and bought puts, lots of them at a much bigger dollar value. This is driving up the put-call ratio, drove up the VIX itself, the price of the VIX itself. Because of that, tomorrow could get interesting. What if the number doesn't come in ugly? All of a sudden, you're going to see a big rally in the S&P 500, and those puts are going to shrink on the VIX. That could really shift things. Bond yields would start to shrink a little bit, move a little lower, and the stock market would rally. And all of a sudden, anybody that was betting for a short scenario now is going to have to move in and start buying the S&P 500, maybe even buying calls, and we could get things moving out of the line. But the market really thinks that the S&P 500 is going to go lower when you look at this chart, the put-call ratio. So there's two variables to look at. The number, the absolute number, the ratio itself, and how much each of those options are they driving up the price. So when we see this big spike upward, you have to kind of consider those two things. It's important if you are a trader looking at these kinds of metrics to understand what these numbers mean. It gives you an idea as to what to do next. It'll be interesting to see if we see the put-call ratio spike even higher or collapse. We'll know that tomorrow after the inflation data hits. Make sure you hit the like and follow button. Follow the links below. I've got 3 channels now, and the website itself is going to be shifting a little bit. So for all of you that have been following along so much, thanks so much. Look for big changes. We'll see you in the next video.